Good morning. This is Richard Cheng at the Sativa Segment. Today we have Matt Hawkins with Entourage Effect Capital. But before we get into it, this episode is fueled by Ritter Spencer Cheng. It's a local law firm based in the North Dallas area. If you want to know and learn a little bit more about it, go to the website, ritterspencercheng.com. Matt, thanks for coming.
You bet. Thanks for having me.
Yeah, I've been looking forward to our discussion. First and foremost, well, I've spoken to you before about some of your funds. So the discussion today, we'll kind of dive deep into, your investment strategies and, what kind of portfolio companies you're currently operating and some of the other things that you did along the way to lead up to where you are today.
Great.
You're from Texas, aren't you?
I am. Grew up in Dallas, went to University of Texas.
Go Horns.
Go Horns.
Even though
we lost over the weekend.
That was a stinger, huh?
Yeah, it wasn't a great game, but they've got a lot of talent. I think they'll bounce back.
Yeah, I think they're. They didn't drop that badly. I think they only dropped like 3 or 4 spots.
Right. It's so early.
Yeah. So you went to UT, and based on my understanding, based on our past conversations, you got into investments, but by doing something else. You're going to have to remind me.
Sure. No, I mean, long time ago, I was with a boutique turnaround shop.
Mm-hmm.
And
that's right.
We were packaging assets that were in receivership or, there were also some private workouts that we did.
Mm-hmm.
And that, kind of got me to interfacing with the buy side. And then I kind of switched teams and went to a large institutional firm and have worked with some family offices. I've I've raised multiple funds for varying strategies over my career. Mm-hmm. And cannabis was just one of the areas I started focusing on in 2014.
Okay, and what came across your desk to have you say, "Hey, listen, I want to focus on cannabis"?
Real estate opportunities. What happened was in the downturn. We had looked at some debtor in possession loans, looked at some broken real estate loans. Mm-hmm. We started buying assets from banks that were residential real estate portfolios. That led to some multifamily strategies. But one of the things I started seeing just through deal flow was in 2012 was when Colorado, Oregon, and the state of Washington went recreational legal for cannabis use. And there were warehouse owners along the I-70 corridor of Denver that were looking to refinance their mortgages out of commercial debt into private debt. And that would then give them the ability to lease those facilities to cannabis growers because they weren't able to do that with a commercial mortgage due to the federal illegality. So we were able to charge high rates. The landlords were charging, high rents to the tenants. But we closed a loan or two, and that got me into the game. And I started thinking, I've got access to all these operators. The yields are likely going to dry up on the real estate side. Why don't I try to underwrite these assets in the cannabis space and see if I can raise some money around that, maybe have a first mover advantage? And that's what we did. And so 2014 was our launched for our first fund. That was a fantastic success. In fact, this year we've sent out our final K1s for that fund, and it was a very high multiple for our investors. And then after that, we did fund 2 and fund 3.
So in short, you developed a pretty deep Rolodex through the real estate side.
Correct.
Tell me one war story involving a lease. If you can recall.
Well, there's plenty of war stories on the cannabis side.
Tell me about that.
The leases.
Tell me one.
Our loans all paid out and matured, and were very successful. But when we invested in Fund 1, this was a rising tide, and we were early on. We had the benefits of being able to sell to what was then a brand new public marketplace in Canada. We were smart in that we opened Canadian brokerage accounts. We were able to exit positions probably quicker than most, just because we had those ready. And a lot of that was luck. And we got advised to do so, and it was a great piece of advice. And so that generated some great returns for us. Fund 2 has been difficult because we were investing at the top of the market unbeknownst to us. But once we made over half our investments, the industry just tanked, and it really hasn't recovered since. So the war stories are investing in strategies that we thought would be fantastic for a burgeoning marketplace that just disappeared overnight.
Yeah.
And really, unfortunately for the industry, until regulatory change occurs, that's going to be the case, because a lot of capital has been burned, and recognize it was all high net worth individuals or family offices, because institutional capital can't invest in the industry because of the federal illegality. So until that changes, this $30-40 billion domestic industry is being supported with, small amounts of capital, and that doesn't work. And not to mention the fact that without getting bank debt and and credit services that are commercially available to you at commercial rates, right, you're stuck because you can't grow your business. So it's a problem. But so Fund 2, it's been our one big war story. Fund 3, we were investing at the bottom of the market, and that's been a lot better. So it's the unfortunate reality of being a fund manager is some funds are good, and some funds aren't as good.
I think it's really interesting to see the evolution of perspectives, right? I mean, let's just take the 11 years that you've been in the industry. And I got into this in late 2013 purely by accident.
Yeah.
But
so you're a wily veteran too.
Yeah, fortunately or unfortunately, depending on how you look at it. But it was a handful of years ago, people talked about it being a $30 billion industry, and that was somewhat underestimated. Some people were calling it even more, like 50, 60 billion, right?
Well, the reality is it could be close to an $80 billion industry, because we still don't know how much of the illicit market has been converted yet.
Yeah, right.
I mean, that's the big thing,
right?
That there's just a small sliver, probably 30, 40, maybe 50% of the industry has been converted, but there's still that huge number that's out there that until we can get to the point to where regulatory reform happens, we won't be able to do it because of the costs.
Yeah. It's interesting what you said too, but with this relatively big industry being supported by a small demographic in their capital, right? And it's really hard to access capital these days.
Yep.
People are being more selective. There was a period in time, probably around the 16, 17, 18 era, that there was a heightened level of enthusiasm.
Oh my God, 100%.
Right. And the enthusiasm was through the roof. And
we were oversubscribed on Fund 2 for that very reason. And then
that was probably around the era of your Fund 2, right?
We were raising money right around that time. Yeah. And it was some of the easiest money I've ever raised.
Yeah. I mean, again, in that 3-4 year period, I remember it just being, it was crazy.
Yeah.
And then I think 1920 hit?
1920s,
of course.
when
19
really, because it was before the pandemic. 19
That's right.
was really maybe even late 18.
That's when you start seeing people liquidating their assets, right? A lot of the bigger companies, they were cash poor, they were liquidating their assets. And some of the bigger companies, they were divesting a lot of their verticals essentially to become more cash positive. And I know there was a period in time where people were looking at structuring their debt and leveraging some of the debt. And there were some challenges with that too.
Yeah. And there was there was a big movement at that point to get out of owned real estate so you can monetize that. And so then all of a sudden, once you do that and you spend that capital, well, then you're asset light on your balance sheet, and you really have nowhere to go at that point except for high yield, private loans, and it's just you can't grow a business that way.
And then the loan gets called.
and we've been dealing with that vicious cycle now since that time.
Yeah. So let's pivot a little bit. Tell me about how Fund 3 is doing. I mean, Fund 3 is the most recent one, and it sounds like your investment strategy with Fund 3 is a little bit different.
But we've really, I like to say we've matured with the industry in terms of where we invest.
That's right.
Fund 1, all we could do was
Fund 1 was easy for you guys.
Well,
Fund 1 was easy for you guys.
I wouldn't say easy, but it was
comparatively to Fund 2.
100%.
Right.
From a comparative standpoint, but we still needed to pick the winners, and we got lucky to get in some deals that we had access to. So Fund 1 was early stage startups because that's all that existed.
Yep.
Fund 2 was more Series A, larger check sizes.
Sure.
And then Fund 3 is more, we've even though we have a sprinkling of early stage deals, most of those are later stage growth capital investments that are again a little bit larger in check size than it had been previously. So so it's now, I mean, we're, I don't know what inning we're in now. It seems like we've been stuck in the third or fourth inning of the industry for, like you said, since probably 2019. But it's still early enough to where, especially in Fund 3, when valuations just hit the floor, we found some really good opportunities at distressed pricing. Yeah. And so if we can just kind of hold on with these companies until something happens regulatorily, which I feel like we're getting closer. We're getting close.
Yeah. But I feel that we are too.
Once that happens, there's going to be a floodgate of capital that enters, but
you guys would have gotten in early too.
You got to be around in order for that to happen. So we just keep preaching to our companies, hoard cash as much as you can. Grow the business where possible, but recognize there's going to be a day coming when we can go out and hopefully, redo some cap stacks to where it's a lot friendlier capital.
Yeah, I'm sure it helps that you're getting into some distressed companies, and the valuation.
In some cases,
valuation's got to be lower.
Yeah, it was more of distressed valuation. At least some of the companies we invested in Fund 3 are still doing incredibly well. Some of the Midwestern operators we invested in the Mid-Atlantic, those areas where it's not as penal from a taxation standpoint and a regulatory standpoint as it is in California or in Colorado, then those have been, we just got in at good valuations, and we've been able to watch these companies grow, and when the right time occurs, hopefully an exit will be at a multiple that makes us all happy.
Right. Let's talk a little bit about your company. I know that the evolution of the name was, I don't want to call it an issue, but there was a reason why you changed your name.
No, it wasn't an issue. It was really kind of funny. We were, so Cresco is, I think it was Greek for, I can't even remember, Latin or Greek for grow.
Okay.
And so when I founded the company in 2014, it was Cresco Capital Partners was the name of the company. And around 2018, probably, we started getting confused with Cresco Labs and vice versa.
Right.
And it was just funny because I ran into a couple of the C-level guys at Cresco Labs, and we were laughing about it over drinks one night. And finally, just got to the point, it's like, it makes no sense. They have a brand they're trying to grow. We're just a fund, and we changed the name to Entourage Effect Capital. And it's been great. Obviously, you don't have to worry about the confusion anymore. So that was the reason behind it. Was
that around Fund 2 when you guys changed it?
Yeah, it was probably right when we were in the middle of the fundraise for Fund 2. So it's been a while now.
Okay. Yeah. So because I've known of Entourage Effect Capital for a number of years now.
Yeah.
So tell me about your portfolio companies and some of your investment strategies within Entourage Effect Capital.
So since day one, we've kind of invested up and down the value chain. We weren't scared to touch the plant at the start, as a lot of funds.
That's very different than a lot of
funds back then were, did not invest in plant touching operators. We did. Some of our early wins were GTI. We got into GTI before they were public. We invested in Acreage when it was High Street Capital, and we sold all those positions, which was great. Even today, we're still invested in multiple multi-state operators, but also non-plant touching assets too. A lot of the picks and shovels, a lot of technology plays, but there's also service providers. So there's the whole gamut of the vertical where we invest in.
Okay, so I'm going to ask you a question that you tell me how much you can say. If I were to give you a check and say, Matt, I'm going to cut you a check for $50 million. What sector within healthcare? Oh, I'm sorry, within cannabis would you personally invest into?
I don't think that we would vary our strategy. I think there's too many opportunities, across all the sectors to take a look at. Now, does that mean that we would invest in 10 different verticals with that 50 million? I don't think so, because I think you need to write a big enough check right now to really clean up, balance sheets for companies that have some wherewithal.
Okay.
So we would probably pick, an operator or two that was plant touching in multiple states, and probably in the, somewhere in the Midwest, Mid-Atlantic, maybe in the Southeast where it's medical, perhaps going towards adult use. But we would also look at service providers that are nationwide, that don't have to worry about crossing state lines like you do with plant touching companies.
Okay.
So I think it'd just be more about looking at an opportunity or opportunities that were big enough in scale to where we could make an impact with a probably north of a $10 million check with that allocation.
Okay.
And that's kind of the strategy that Fund 4. We have not launched yet, and that's by design. We want to kind of just get a feel for when regulatory reform is going to happen. And we've been talking to some institutions about, when that happens, would they be ready? And the answers are usually yes. And so it would be a check around that size that is something that we would be interested in looking towards getting, and probably larger than that. And the strategy would be the same as I just described.
Is there a particular industry or a particular sector you think has a higher yield or less risk than some others?
Less risk. I mean, I think that's two different questions. I think
they're very different questions.
So I think there's probably higher yield and a little more risk in the plant touching companies that are trying to get into different states, perhaps.
Okay. Yep.
Probably less yield, little safer, non-plant touching companies that are big enough to where you're not going to worry about capital constraints. They have multiple clients.
Yeah.
Not have to worry about losing their top two clients and going out of business, for example.
Right.
So you got to just kind of weigh the pros and cons of that and how you want to blend your overall return of a fund.
Okay. And I think from our past conversations, management team is pretty vital when considering a target. What are some other critical factors you also consider when you're
management is first and foremost. I mean, it's we've been burned by maybe looking at something and saying, we really like this company. The management could be a little bit beefed up here, and that burned us. So it's got to be management's got to be front and center of your analysis. But we also obviously look at the market size of that particular sector. We look at what their what their customer base is. I mean, and then things like what's their debt? And right now, debt is a huge issue. And are they on the verge of something drastic happening? Is there an opportunity there on the debt side of the capital stack? Where are their trade payables? I mean, what's their relationship with the industry? I mean, all these things, when you're in a distressed environment like we're in, you got to look at all those things because, the industry is plagued with slow payers right now. And the ones that are going to be successful and the ones that are successful now are the ones that are able to pay their bills. And so you need to make sure you can, find those companies that are going to be rewarded going forward because they've been true to their clients and customers and vendors to date.
Right. No, I totally understand. You've mentioned regulatory reform on a couple of occasions now, in this, during our discussion. Name me one regulatory reform item that would really shift or change how you guys invest.
Yeah, I mean a Safe Banking Act that would allow institutions to come in without having the this overarching federal illegality over their, it's just kind of keeping them abreast right now would be the big one. But the rescheduling also helps too. Okay. Both those, and I feel like they kind of go hand in hand. I think when one happens, the other's going to happen. But it's just which one's going to fall first. I think Trump has been saying since even back in the fall before he got elected that this was he wanted to reschedule cannabis from Schedule 1 to Schedule 3. And that would eliminate the penal 280E tax that exists at the federal level, which basically doubles your tax rate at the end of the day. It would free up a lot of cash for some of the bigger companies, which would be huge, and that would trickle down throughout the industry. And I think once that happens, then the kind of the stigma gets removed even further at a political level, and I think then hopefully safe banking could occur. I got a kick out of this 2 summers ago when oh my God, what's his name? Bill Maher said that if the Democrats aren't careful, the Democrats aren't careful, the Republicans are going to steal this issue from them, meaning cannabis.
Okay.
And he has said it again here in the past few weeks about rescheduling. And he said if Trump does this, then poof, this becomes a Republican issue, not a Democratic issue. And the reality is that almost 80% of Americans live in a state where it's at least robustly medically legal. And not only that, but approval ratings are still hovering over 75, 80%. I mean, you've got a lot of these, prohibitionists that are saying that that's not the case. Well, that's just facts. And if America wants this, then it becomes a political issue, and the politicians are going to listen to their voters. And I think the far right, who's fighting it, is going to have to be, kind of stand down because they're running out of percentage points here.
Well, the Gallup poll doesn't lie.
No, it doesn't. Yeah.
Okay, well, as we wrap up here, tell me one item that Entourage Effect Capital is really considering in 2025 for as you move into the future.
Well, 25
that you guys are working on, I guess.
Yeah, I would say probably regulatory reform. We're keeping our eye on that as closely as anything, and we're hopeful that can happen this fall in some form or fashion, because then that would set the stage for 2026 and how we go about deciding when to launch our next fund. And because if we get delayed, then we're going to have to kind of delay the fundraise because there's just, and that's a microcosm of what's happening in this space. When the capital providers like us, and unfortunately we're one of the larger capital providers, historically in the space. And if we can't raise money, then the industry's not getting any money.
That's right.
So we're trying to be thoughtful about it and not waste our time and our investors' times until there's a moment in time to go do it.
Because right now you're just on a holding pattern. It's fair to say.
On the new money side, yes, we still have dry powder in Fund 3.
Yeah.
Primarily used for follow-on investing in our existing portfolio.
Okay.
But with the right opportunity, we would perhaps do something new.
Cool. Well, thanks for making the time.
Absolutely,
I appreciate you coming on the show, and it was really enjoyed talking to you.
It's great to be here. I'll do it again.
Okay. Sounds good.